Okay, I think I've been given the go ahead to start. Okay, so today's webinar is very interesting. It's called Into the Multiverse. So Samyuktha won't be able to join in. There's something that has just come up, so she will not be able to join in. So I will be taking the whole thing. And the topic of why we chose, Into the Multiverse is very simple. We still think that for a multi-asset in the multi-asset space, not a lot of investors actually know what multi-asset really is and how is it actually helping all investors, right? We think that it is a very conservative product. We think that it doesn't really work, but no. What I'm going to show you is all public data. These are all data from industry multi-asset funds out there, and they've done a lot of work in terms of uh, educating the market about how multi-asset works, and then I will lead you into what Sphere does as as a dynamic multi-asset PMS, and how Sphere is managing the entire multi-asset uh, allocation, right? So everybody knows Howard Marks. Howard Marks is a very this is a very famous quote by him. The only certainty is that cycles will come and go, which means that winners will keep changing and winners and losers will keep changing. Which means for one cycle you might have a large number of winners, the same winner that keeps coming again and again. But then in the next cycle you would see things starting to turn. And this is not only from the market perspective. This is even from the business perspective. If you see monopoly businesses doing very well for an extremely long period of time without any ring fencing, which means there are no competitive advantage to that particular business, you will see a lot more people coming in, and it's all completely a cycle, right? So the only certainty is that cycles will come and go. So mentally, as an investor, you need to be prepared that I have to weather through all of this, right? That's the only goal for an investor is I need to weather all of this without getting much of a dent, without too many scratches, and then I will be fine on my investing journey. Right? This is a savings vehicle for me, and the least amount of scratches for me is all good. Right? That should be your only goal as an investor when you read this. Now, right. So, what is the deciding factor when it comes to portfolio returns? Now, this as a portfolio manager, right? What is that factor that actually gives you that sort of extra returns, right? A lot of people spend time when it comes to deciding when should I buy. I'll time it. I'll wait on the sidelines and I'll decide at that given point in time what I have to do. I think from here it will fall too much. I'll wait. I think from here it's going to go up. So let me go put in all my money. Right. Uh, Surprisingly, when you see this study that was published in 1986, it stated that asset allocation is the most important decision that explains portfolio return variability, which means this is why if when you compare yourself with your peers or in the fraternity, if you compare industry fund managers, what is the deciding factor that is actually pushing towards more returns, pushing them towards the higher ranks, is not timing the market, is not what they buy. It is asset allocation. It is how much they buy, right? How much of what they buy, right? So it's all about position sizing, and it has nothing to do with timing the market. Right? Everything has to do with how much, not what and not why. It's how, right? How much of it are you going to commit to that particular thing? So that entire thing is around 91.5%. Right? That's the most important factor when it comes to making returns. It's not choosing what you want to buy. It's not choosing when you want to, right? That's a very small percentage about it, right? So uh, and these are all public data. Like I said, all of this is from existing multi-asset mutual funds outside. So it's a very, very good study. Right. So from this, we get to know that no, we have to look at asset allocation very, very seriously. And why do we need to look at asset allocation very seriously? Now, if you see, when you combine assets, right, when you have equity portfolio of 65%, a debt portfolio of 20%, a gold portfolio of 15%, you see the variability in returns is very low, right? The volatility is completely low compared to a all gold or an all go sorry compared to an all equity portfolio, and debt is very minimum. There's no volatility when it comes to debt. But if you look at gold, given currently the scenario with the dollar being very volatile, you're seeing global gold also doing going on the volatile side, right? So if you look at the combination of all the three asset classes, right, your volatility is quite low and your returns are more or less very similar to that of all the three asset classes, right? But we as an investor, what do we really look at? We only look at the highs. We don't really look at the lows. We look at the highs. We don't even look at the median. We don't even look at the average. We don't look at anything. We just see high, right? When we go shopping, we see low to high, but here we see high to low. That's our filter, right? But as an investor, what you should be looking at is not high or low. What you should be looking at is consistency and low volatility, right? That's what multi-asset is actually giving you, right? It's more predictable, right? It gives you an equal opportunity to participate in all asset classes wherever there is an opportunity, whenever that opportunity comes up. Like for example, today, when we go on, a lot of investors have this question on should I wait? I'm sure you would also have this question: should I wait as an investor? Right? But the whole point is that opportunities are not present only in one asset class, right? There is debt, there is precious metals, there is gold, right? There is global as well, right? But the whole point is, if you look at only one asset class, then naturally you will think about the least factor in determining your portfolio returns, which is timing. When you look at asset allocation, you easily see, no, I have opportunity on the debt side, I have opportunity on the gold side. If something opens up for me on the global side, that's what I would do. But we get very obsessed with the highs, right? Our filter is only high to low. It's not a consistency, nor is it low volatility, right? So from this chart, multi-asset does give you that sort of consistency. It does give you good enough returns when you're compounding over a very long period of time. At the same time, it gives you it eases out on your journey. It gives you a very comfortable journey as you go ahead, because you are not looking for 1 or 2 years, you're looking for 10 years plus, right? That's what you should be looking at when you are saving money in the market. If you have all the goals that you want to meet, definitely it will be 10 years plus. Now, what happens when nothing happens, right? If you look at Indian equity now, because we are so equity focused, right? We are all very equity heavy, right? From 1997 all the way up until 2003, Nifty return was zero. International equities from 2005 up from 2000 to 2005 was 0%. Gold from 2011 till 2019 0%, which means that, see, you're looking at 3 4 years, 5 years also, but then you don't see any returns coming in. What happens when nothing happens? That's why we do not stick to only one asset class. That's why we always say no. There are other asset classes. At that in that particular period, debt would have done extremely well. Would have done extremely well, right? But because we only look at one particular asset class, because we are trying to make the most out of just one asset class, when nothing happens in that one particular asset class, you're sort of not making any wealth. It doesn't add anything to your journey, and this is what happens when nothing happens. Like now, when it comes to this current market scenario, you are in a very similar scenario where markets are peaking. There's very high optimism. Things are looking up very strong, right? And in this scenario also, valuations are going more on the expensive side. So debt does become an opportunity. Gold does become an opportunity, right? Uh, Now, when the going gets tough, right? If you see when crises are hitting economies, if you look at all the crises that are coming up, you are seeing domestic equity returns go down. You are seeing international equity returns also be extremely volatile, right? You're having 1 year of bad year, and then suddenly you are seeing uh, it's shooting up the roof, right? But again, if you look at domestic equities, because it's varying, because any crisis, you cannot predict any crisis that comes your way. Naturally, when you're stuck to one asset class, you will have that sort of problem. So if you look at multi-asset, where you just have an equal weighted sort of a return, there it protects you during the downside. The main thing is, if you look at domestic equity returns during the Greece default during 2002 2012, you're seeing domestic equity returns go down by 14%, debt go by 8%, international not very much. But then if you look at multi-asset, it has stayed, right? So there's a wide outperformance. There's a wide outperformance during a particular phase in the journey, and that is during crisis. In times of crisis, you'll always have this sort of scenario where the multi-asset approach sort of protects you from all the volatility that's coming. Right? This is one of the benefits by having a multi-asset sort of an approach, right? Where you're seeing two asset classes already going down in terms of the weight, which is domestic equity, domestic debt. Your international equity doesn't move much, but your gold covers up for everything else, right? Your gold covers up and make sure that you don't go through a very bad cycle, right? Likewise, when you are in a growing scenario, uh, you are seeing that multi-asset almost very similar to what your domestic debt, your domestic equity, your international equity, and your gold is performing, right? So if you see, if you look at India, the last 12 years, multi-asset allocation, that is just equal weight. You don't do any sort of dynamic asset allocation where you change given the particular cycle. No, it's the same. Right. There your returns coming up to be 11%. Domestic is 15, domestic debt is 7, international is 9, gold is 12. Here you go. Net, everything doing very, very well. You're compounding again at a very high digit, that is 11 or 12%. You're not taking that sort of volatility that comes with equity, but at the same time, you're making that sort of equity return because of that extreme outperformance when the time goes bad. Right. And that actually gives you an opportunity for you to scale up more on a particular asset class, right? So naturally, when the returns, when the tide changes to good, you will be rewarded the most, because you are sort of doing that dynamic asset allocation when the time comes. This calculation is more to do with equivalence, right? But when you do a dynamic sort of an asset allocation, when the tide turns, naturally this 11% will be much higher than the equity returns as well, right? This is why your multi-asset approach works. This is why your multi-asset approach is actually beneficial for you as an investor, right? This has nothing to do with conservatism. This has everything to do with being there in all the asset classes, and if you can add that dynamic layer of it during cycles, then it works. Right. This is what we were talking about, how the drawdowns, which means that even in the worst period, your drawdowns are very low. So even if you look at COVID that is coming in, your drawdown is pretty low when it comes to a multi-asset allocation. You look at the reds compared to the greens are quite low. Right? Yeah, there is a drawdown actually, but the outperformance, right, is very, very large. Right? You're well protected during the down period, and you're very, very well protected. Yeah. So this is why the Howard Marks quote actually comes in. This is where it comes in. If you look at uh, the whites, which is the multi-asset returns, your multi-asset returns are very, very consistent when it comes to building wealth. Right? It has sailed through all periods of stress, all periods of good times. And if you see, since 2010, we've had multiple colors. Right? It's debt has come twice, equity has come in 4-5 times. Gold has been a consistent outperformer for years together now. So if we look at from 2018 onwards, gold has been the best performing asset class uh, on a compounded basis. If you look at 2012 all the way till 17, your equity has done extremely well. So naturally, if somebody had invested, in 2012 in a multi-asset approach, still you're compounding at very, very high rates, right? Because your equity takes care of the majority of returns. When equity is not taking care of that return, you have gold that is coming in from 2018 onwards, right? Your debt has still not participated, mind you. Look at the bottom, your debt has still not participated, right? And this has been the case since 2019, right? Where your debt is not performing. We again are at a period where GSEC is somewhere around 7.2, 7.3, and that the 2-year, 3-year space, there are a lot of spikes when it comes to the yields internationally, not even just in India. So definitely there is a very big window that's opening up on the debt side. Right. But here winners keep changing, and the winners of the past that turn into losers, uh, the effect of it on the multi-asset allocation is very less, and the winners of the new cycle actually take over and give you that sort of extra return. Again, when you see when you deconstruct this entire quilt, right, here you have category wise, you have some periods where small caps are outperforming. You have some periods where large caps, look at large cap is extremely consistent. The greens have been extremely consistent, right? Then you have internationals that are some way coming in and picking up the pace. Then you have gold, again seen from the previous chart, gold comes in and picks up that space, right? So here you have the entire winners and losers list, and it's very evident if you see from 2010, gold has been up. From 2014, you're seeing small cap all the way till 17, and from there again, from 2020, 2021 onwards, your small caps have done extremely well, but gold has remained consistent. Then you're seeing international do very well for 3 years, but not do well in the last couple of years. If you see, it's varying a lot, right? Though the returns have been high, but it has been varying a lot. Then if you look at uh, one particular cycle on the debt side, you see 11 to 15, 11 to 16 was a very good period to look at debt, right? Though they are coming bottom at the bottom, but for debt, they have done extremely well, right? So this is the entire chart deconstructed. Uh, and this is just to highlight, winners of the past need not be winners of the future, right? I also did a webinar to just to see how behavior works, right? Where I was able to uh, start from 2023 and go back and ask investors as to what you would do, and you won't believe it, the answers kept changing because we are so biased. We have this hindsight bias where we only see what has happened before, and we don't look at what can happen. And this is where multi-asset comes in, because it takes care of what can happen. It is going to protect you from what can happen, also benefit you for what can happen, right? But it was a very interesting webinar. It is there online on YouTube, on the Milestones to Wealth page, so you definitely can go through that. Now if you look at the 5-year forward, if the investment is made when the markets are near its 52-week high, you're which means that you're doing at the top, right? Let's say we go ahead and start timing also, right? Where the valuations are very high and that momentum is quite strong. When that period comes in, you still make somewhere around 9 to 11% return, right? If you just do equity, right? But if you do a multi-asset approach, with this is the current scenario that we are at, right? Where we are nearing 52-week highs and your valuation is not very high, but yes, on the higher side, right? It's somewhere just above fair, but it is somewhere on the higher side, right? So there, your return expectations only happen to be 9 to 12% in the long term. That is forward. But if you look at the multi-asset, there your returns are somewhere around 12 and a half. Not big difference, but the risk that you're running here is because you're starting at a higher valuation, not at a 52-week high. You're starting off at a higher valuation. That's why your returns are low. But if you start from a lower valuation or a moderate valuation, naturally that goes up. Right? That contribution of equity comes in and it goes up. So the whole point that we're trying to make is that in this sort of a market where your equity market is very, very optimistic, where equity market is very, very bullish, you have to look at other asset classes. Okay, there is opportunity on the debt side. There is opportunity on all the other aspects of asset allocation. So naturally, you should be looking towards that, because the risk of having that big drawdown, or the risk of having a drawdown, third risk, the risk of equity markets not doing anything comes up. It naturally, you must look at the other places. right? So if you start from a point where valuations are on the higher side, then your returns are low. But if you wait it through, if you sort of weather it through by having a dynamic asset allocation approach, naturally you're getting lower, you're minimizing that sort of risk of valuation drawdown, right? So multi-asset investing makes more sense in this sort of a scenario, in which valuations are somewhere expensive, and the momentum in the market is quite optimistic. And if you look at where the money is really going, the money has been going into sectoral and thematic funds, yeah, which is playing on the front foot. But if you look at uh, hybrids, we've not had many hybrids that have been coming in, but a majority of the money has been going. These are our NFOs. The majority of the money has been going into sectoral and thematic. A lot of sectoral and thematic NFOs have come out. Now there are a lot of multi-asset NFOs that are coming out. So money is going there. Money is going into places where the entire industry is trying to play at a front foot. Right? Not proven ideas, not proven funds, but yes, the money is going into areas that are playing at the front foot. Now, what have we learned? One, yes, multi-asset investing works. Who does it work for? It suits a wider range of risk profiles. No matter what your risk profile is, you can do this sort of a multi-asset approach. And when it comes to risk profile also, because you can take a higher risk, definitely equity contribution can be more. If you cannot, naturally, the returns for a multi-asset will be higher than that of a debt product, because you're having debt and gold altogether, because that there will be some component of equity also in it. And even if you go overweight on the debt side, naturally it would suit you and give you higher returns and lower volatility than a debt fund, right? Slightly higher volatility, but in terms of what you're getting, it will be much better, right? It exceeds the moderate investors' return expectations. Naturally, it does, because we only look at one asset class, because we are pegging it to one particular benchmark that is 100% equity. We are underappreciating the fact that in terms of the risk that you're taking, in terms of what risk that the product offers you, your returns are much, much higher. Right? Here, you're only trying to optimize your returns when it comes to the risk that you're taking. This is why we say moderate valuation to lower valuation. That's the best point for any investor to look at when it comes to investing, whether in equity or whether in a multi-asset fund. Okay. It allows investors to participate continuously, which means, like I said, some markets, something works, but then you want to wait at the sideline in the next market, saying, no, I would rather wait because this one asset class is not favoring me. Where you forget that, no, there are other asset classes that are favoring you. So, this is where multi asset allows you to participate in opportunities that come up in any market, in any asset class that is present to you, be it global equity, be it global debt, right? I think recently in the last 2 months, we've had global debt funds also launched in India. So they are all fund of funds. So yeah, we are also exploring that opportunity to look at how we should consider interest rates in the US, how we can consider this as an idea, right? Which means that the industry is offering you many ideas, many themes, but as an investor, we only want to be concise and stick to one, right? And that is where we have to broaden up our horizons to say, yes, by choosing multi-asset, I am going to be participating. It gives me that option to participate continuously in various asset classes. This is where Sphere comes in. So let's look at the PMS space now. We've seen the multi-asset space. Let's look at we've seen the multi-asset industry in India. Let's look at the PMS space, which is just multi-asset PMS in India. So if you look at how we are structured, again, because we are equity bias, naturally, majority of the discretionary PMS AUM is equity. This is somewhere on the this is November data, but equity happens to be a majority part of it. Multi-asset and hybrid, which is combined, is just 4% of the entire AUM. So it's still very small, right? Because we have that sort of equity bias, right? And majority of it would have different themes, where some would be small cap, some would be flexi cap, but multi-asset is just 4% of the entire AUM. Now, if you look at in the multi-asset space, right? When you compare the mutual fund space and when you compare the PMS space, uh, somewhere around 10,500 crores, 10,400 crores is discretionary, which means that this is where the fund managers, this skill is coming into play, and they are executing for you, where they are the one taking the decision. So that entire space is just somewhere around 10,400 or 10,500 crores of the entire industry, right? Which is both mutual funds and PMS. Now, if you look at non-discretionary, which means where the investor is the only one making the decision, and they're only going to someone to execute it, right? And they're paying a fee for it. That's quite a large chunk of the entire PMS space, right? It's 31,500. So 1/3 of the entire space is only advised, right? That's how you can look at it. Everything else are investors are taking their own decision, where they want their biases to come into play by having more of one asset class, right? But it doesn't work that way. You need to have this sort of dynamic asset allocation, and have a forward looking asset allocation, where you are at where you do look at asset allocation more from a point of okay, how you can weather through volatility than how you can make that extra return, right? Always be conservative when it comes to what you want to pay for a particular business, right? Now when you look at the entire mutual fund space, that is the multi-asset mutual fund space, is somewhere around 49,000 odd crores, which is quite large. So the entire space put together, the discretionary payments, which means where the fund manager does come and play a role in the entire asset allocation space, is very small. Is very small, right? This is where Sphere is operating. Sphere is operating in an extremely small niche space, uh, that is still growing, and as we keep doing such webinars also, you would see more investor education coming in. There will be more interest coming in. Naturally, we will go through that entire space of growth. But the whole point is that the discretionary PMS space, where the fund manager makes active decisions in asset allocation, is very small, and it's very niche. And if you look at the AUM split up that's there, 60% of that entire discretionary PMS space makes up only the AUM makes up is less than 100 crores. 60% of that entire market is less than 100 crores, which means the AUM is less than 100 crores. Very young, very small, and not a lot of investor interest, right? But the main thing is that if we look at the average return that has come in on that space, is somewhere around 7 to 8%. This is since their inception, and this is all public data. If you look at where Sphere is operating within the 100 to 500 crore, which is 28% of the discretionary PMS space, there your average returns come somewhere around 12.5%. Right? Still very young, still growing, still unproven, still getting proved. Right? If you look at the larger ones, there again, they just make up 12% of the entire AUM. More than 1,000 crores are just 6%. But even there, they've been underperforming. Somewhere around 12.5 to 13% is what they've sort of made since their inception. Even on the 500 to 1,000 crore, which is somewhere around 10 to 11%. But the point is, on an average, right here, what we saw on the chart, going back somewhere around 11 to 12% is it should be your base expectation, and this is what the entire industry on the PMS side has also gone about and performed over since their inception. That I cannot put here, but since their inception, right? So what has Sphere done since its inception 2 years back? So we have had very strong years, because we are dynamically managing asset allocation, which means we don't have a particular cap. Now, if you look at the other in if you look at the entire industry, there is a cap, which means that you cannot go in a particular, you cannot go beyond a particular point in an asset class. Say for example, equity is 65%, which means you cannot go beyond 65. You're capped. But because Sphere is dynamically managed in terms of asset allocation, we don't have a particular cap on the asset class. We can go from 0 to 100 in any asset class, be it equity, debt, gold, or cash, right? Precious metals. If we start getting more precious metal exposure, where we have more ETFs and more fund of funds, naturally it gives us that option to consider when it comes to parking money there. But because we can go 0 to 100, we are not capped. Naturally, we are able to make the best of a particular cycle, right? If cycles are more tuned towards equity, we are able to make the most of it. If cycles are more tuned towards debt, we are able to make the most of it because we don't have a particular cap, right? We are able to do what is required in that particular cycle, right? So if you look at the last 2 years, if you compare us to a multi-asset fund that's out there, that is the pure mutual fund, the returns have been somewhere around 11%. It is industry standard, right? This is the number that is industry standard, right? If you look at a flexi cap equity fund, which is 100% equity, some there it is somewhere around 12.5%, right, for 2 years since our inception, and our outperformance has been quite large. And the only reason of why we've been able to do this is because we don't have a particular cap. It's second, all portfolios that come in on the PMS, every investor has a different portfolio, which means that even within that particular asset class, like I said, when valuations run up, we cannot chase it, right? We cannot time, but we can be conservative as investors to what we want to pay for a particular business. So we are able to capitalize on more businesses and more ideas that are high quality, that come into that sort of range where we are being more moderate and we're being more conservative in terms of value, in terms of valuations, right? So you would not see, somebody who came in 8 months back having the same portfolio as somebody coming in today, right? Because opportunities are different, because though we are in a long term particular cycle, within that cycle opportunities play out very differently, right? So this is why we are having that sort of outperformance when it comes to our peers in the entire industry, right? So if you look at it from a 1 year perspective or a 1 month 6 month, though 1 month 6 month is not at all relevant for you as an investor, but uh, the data is out there. We have to sort of put out that sort of data, but this is where that wide outperformance comes in, where we don't have a cap, and that we're able to make the most out of one particular asset class wherever there is opportunity present in it, right? By being conservative in terms of valuations and making sure that we have the right position size and we have the right allocation size to that particular opportunity, to that particular asset class, right? Now drawdown. Uh, uh, our drawdown is 11%. That is the worst period since our inception. We've seen a minus 11%. If you look at a pure multi-asset since inception, that is the last 2 years, 2 years, 1 month, uh, your multi-asset is somewhere around -8. But if you look at a pure equity fund, naturally your drawdowns are much higher. If you look at our performance, this is uh, our inception date is 16th December. So cash levels on in December is somewhere around 2%. But what I want you to look at is equity 81%, metals 9%, cash 2%, debt 4%, and we have a significant chunk of global exposure as well. It's not very large, but 4 to 5% is quite large, given the fact that there is a lot of macro level problems on the global side, right? So there also we are able to take advantage of opportunities within the global space that are presented to us as moderate to low valuation, right? This is what you should be looking at in terms of the asset allocation. If you look at our since inception returns, we are somewhere around 22%. But what we endeavor to do is to grow consistently over the next 10 years or so. So this 22% is what you're seeing in the last 2 years, but our goal is to grow at a compound rate of 12 to 15% over long periods of time, which is 10 years plus, right? This way, we are weathering through each and every cycle that comes in. At the same time, we're having a low drawdown. At the same time, you're being rewarded when the times are tough. We can make that switch very, very easily, right? It's a very easy, simple lateral switch that comes up to us because we don't have a particular cap, right? If you look at the entire house, we have 4 products: Solitaire, which is our flexi cap product; True Blue, which is our pure large cap product. You would have only the best of the large cap companies, the best monopolies in that particular fund. You have Vriddhi, which is a small cap PMS, where they operate more like a private equity style of investment than your vanilla small cap funds outside. And you have Sphere, which is multi-asset driven portfolio, right? It's dynamic multi-asset. If you look at the core team, the fund management side, we have Balaji sir, Rohit, Rajat, Niranjan sir. So they are all on the fund management side, where our support only comes in terms of research and strategy, where we are a team, say of 13 or 15 people that are involved in the research, that are involved in making the product, where each and every person is actually working on your particular portfolio. So I'll open the floor for Q&A. We have a good amount of time for Q&A. So whatever questions you have, do put it in the chat box, and I'll be very happy to address them. Okay, there are a good amount of questions. Hi, if asset allocation is indeed the key, then why mostly only equity funds alone are suggested everywhere across around the financial advisors fraternity, and no debt, no gold at all? All asset classes are important, if not equal, but trend now seems to be overemphasis and hype on equity alone. See, when I'll tell you the truth. See, when it comes to expertise in this space, not a lot of advisors or not a lot of the fraternity has that sort of expertise. Like I said, when you saw the entire multi-asset space alone, on the mutual fund side is somewhere around 49 and a half sort of thousand crores. Right. When you look at the discretionary, where the fund manager is actually playing a role in it also, is very, very small. It's only 10,500 crores of the entire, if you look at mutual fund industry put together and you look at the PMS put together, it's very, very small. So the expertise that is there in this particular space is very, very small. There are not a lot of experts in this space. That's why you see wherever there is an expert, only then you will be able to see that sort of recommendations coming in. Right. And cycles play out differently. So which means you have to be in the industry to know how the cycle plays out. We are seeing so many new fund houses coming out where there is a good they are good experts that they've been in the industry, but not in the retail side of the industry. Right? They've been dealing with retail, but not on the pure retail side. Right. But the whole point is that there's not a lot of expertise because of the fact that there's not a lot of promotion because there's no expertise. And second, not a lot of investors remember how cycles play out. They would have been there in the industry for a long period of time, but remembering how things have played out, what has happened in that one particular cycle, what is the scenario then and what is the scenario now, I think that sort of awareness is sort of why this entire space is small, why this entire space is a very is not really promoted. Right? That's the only case. And we as investors also see, when it comes to demand, our demand is high. Our demand is we want higher returns. Our demand is that because we are having that sort of a higher return, we are being suggested, we are being promoted to look at equity only as an asset class. Right? So somewhere investor education also has to come into play, where because the last 3 years have been extremely good for equity. Right? You saw that chart on which small and mid caps have just gone through the roof. Now, because of that, you're pegging to expectations that are from the past, that are driven by various other factors. Now, because the expectation is pegged very high, because your demand is like this, your supplier is giving you only that. Right? You can also look at it this way. What is the benchmark for Sphere? The benchmark for Sphere is number one, where it's equity, arbitrage, REITs, and InvITs at 50, 40, 10. But the entire concept of your multi-asset PMS is lost by seeing your CR PMS. It's so heavily equity. Makes no sense, sorry, because you spoke so high about multi-asset allocation. See, when you look at the current asset allocation, we are on the equity side. But all our new allocation that's going, we are going more towards debt. Like I said, so wherever there's opportunity that comes in, you are able to participate in it. Right? Because our allocation is not only going to stick towards one. Right. So somebody who came in 8 months back, somebody who came in 9 months back, that's not the only portfolio that we are setting up. We are creating that appetite to scale. Right. Naturally, when you look at saving, you want a vehicle in which is growing consistently and is growing without much volatility, and it gives you that scalability option, which means you can consistently contribute. Right. So Sphere accepts SIPs. Whenever our interactions with investors take place, we are getting a lot of interest from them. There is a good amount of support that comes in. So whatever scaling up comes in that one particular portfolio for that one particular investor, which is why all of us are working to, which is why all of us are working on towards, there the debt allocation starts going up. So this is from entire since inception basis, right? But what has happened in the last 6 months, which is why we have not published that sort of data here, because we want to age it all out. You would see us having a good amount of debt there. So, for example, any investor that comes in today, 100% of the money does not get deployed. Right? Somewhere only about 50-55%. Right? I think it's slightly lower also now, but a majority of it goes into debt. Right? But a majority of it, somewhere around 30% or so, 35% or so of that money goes into debt. Right? And we weather it out, and we make sure that no, we are able to be there in this sort of wherever we are able to make that good return when it comes to debt, we are on that side. And as and when equity or the other asset class presents us that sort of opportunity, it becomes easy for us to make a lateral shift. Right? That's our logic. So what you're seeing now is just a big picture of it. But like I said, because portfolios are built over a period of time, you would not see our portfolios being very similar to what they were 8 months back. So current portfolios that are being built, money itself is not 100% of the money itself is not going out in this sort of market. And wherever there's money going, it's more tilted towards the debt side, towards the gold side, towards non-expensive parts of the market. Uh, where do you see the most opportunity as per your strategy in the next 2 years? See, in the next 2 years, within equity, we only see opportunity more coming in from financials and financial services, and a little bit from infrastructure. On the debt side, we just had a debt presentation on Guild, which is more on the long-term side, right? But the opportunity here that we're taking advantage of is somewhere around 3 years to 5 years, somewhere around the shorter term side of the yield curve. So that's where we are able to find that opportunity coming in. We are still evaluating what can come in on the long term side. It's still very nascent, but right now on the debt side, there is opportunity on the short term side, which we are able to capitalize on. Right? In terms of precious metals and commodities, that opportunity remains very consistent in terms of the macros that are being presented to us in the economic environment that we are operating in. Definitely, the opportunity is very high and it's remaining consistent. If you see over periods over the last six years or so, precious metals have been a very strong performer, and we have been on that side for the last 6 years, and we continue to be on that side. And we do think that going forward also there is a big opportunity on precious metals. Uh, it's a good question. With debt funds being fully taxed now as per individual tax slabs, uh, the lot of asset classes. I mean, debt as an asset class is lost because even CFPs, IFAs, or RIAs or MFDs, they don't talk about debt as an asset class. Everywhere now, yeah, it's true. Everybody talks about equity. If you look at how we have been also talking. In the last 2 years, we've been talking somewhere more on the lines of equity. If you look at all our products also, you would see that there is some bit of a bias in the last 2-3 years. But what has happened is Samyuktha is not there here, but uh, we have an entire channel for debt alone and how we are investing on the debt side. So I think every 2 weeks or so, we do a webinar on the opportunities in debt and educating investors on the debt side. Right. And now I think next month, what lineup is there in what we want to do in terms of investor interaction is going to be more on the debt side. That's already lined up. Right. So in terms of tax, what we are seeing, we have no choice but to sort of go with it. It's a regulation. We are going with it. There's no change yet, but we have to go with it. It's an opportunity. You can't miss it out just because of certain things that are coming in the way. So we are going with it, right? Even during the times where there was no long-term tax, and then suddenly long-term tax came in, short-term tax got bumped up. We did not see investor sort of interest go down, right, in one particular asset class. So, and you're seeing that gold is also being taxed as debt. So you're not seeing the interest go away, right? It's just optically looking like the interest is going away. The interest is not really going away. And debt in India is very nascent, huh? It's still very young. Even in the developed nations like US, if you look at the debt market, they consider debt to be developing, right? Because there are more and more products that are coming up on that side. There are more and more innovations that are coming. If you look at equity in the developed nations, there is high level of innovation that has come up there. Right? You're having leveraged ETFs. You're having more and more manufacturers of ETFs. You're not having a lot of manufacturers of debt. It's skewed, but even they are talking about how the entire debt market is going to open up, and more innovation is going to come on the debt side. Right. So we are in a very nascent stage when it comes to debt investing in India, because there is a lack of education, because there is a lack of expertise. Right. Is it not scary or risky to be overall so much exposed to equities and all chasing returns? Yeah, it is scary that everybody is chasing, one particular asset class. That's why you have a multi-asset sort of an approach. That's why you should consider having a mixed approach. The only reason of why investors don't really go out and do it, let's be honest, because there is a bias saying, no, the returns are not, not very high. I don't want to go out and do it, because we are pegging ourselves to very high expectations. But what we don't realize is when a drawdown does come, when the scary does become real, right? Then your safer parts actually outperform, the riskier parts. That's where it's underappreciated. We don't see those very often, right? We don't see those very often, but we can't deny the fact that something like this can happen, right? So you must have some bit of allocation towards that space, right? And even within that space, where is the opportunity is somewhere on the shorter term side, and that's where Sphere is able to take advantage of it. So whatever happens in the debt market says, we will be able to take advantage uh, within a particular asset class, within that particular category, we'll be able to make the best out of it, right? So yes, so I had done a webinar on just equity alone for milestones 12, which is the our other project, where if you see the inflows that have been going just into small and mid caps have been very high in the entire of January 23 to December 23. It's somewhere around 45,000 crores that has just gone in as net into small caps, and somewhere around 19 or 20,000 that has gone into mid caps. So yeah, everybody is chasing this sort of returns that is coming in, and you as an investor, or rather as a fund manager, you have to be so cautious. And our entire philosophy is that yes, we want to build wealth very conservatively and make sure that we are at the right asset class, in that particular cycle. That's where we want to be. So how can we get to know about your debt series that you mentioned? So we can send you links. Usually, if you follow us on social media, whether it is Twitter or YouTube, on all of our channels, we will be posting, the recording after the entire webinar is done. So you can look us up on social media. But what you can do is you can just get in touch with us at this number. Just send in a hi, just ping us, and we'll get in touch with you, and let's connect, and then somebody would be able to guide you, and somebody will be able to send you all the links of all our webinars. Right. If the interest rate goes down in the coming years, do we get more returns in debt funds if we invest now? See, I would like to understand why do you think that the interest rate is going down? But in this sort of a scenario, interest rates are very sticky. We do not know what's going to happen to the interest rate space. So what can you do in this particular market? If this problem can come in only if you're thinking from a very long-term perspective. If the interest rate goes down, it's actually beneficial for you. But having said that, taking a debt call versus an equity call requires very high expertise. Why? Because debt is a dealer driven market. It's not like equity where you can just go trade in, trade out whenever you want to. It's not very liquid, right? So if you're buying a particular paper, you are stuck with that particular paper unless and until there is somebody on the other side of the counter to buy it. Right? That's what happens with bonds. That's what happens usually with debt. That's why mutual funds have made it very easy to participate on the debt side. Right? Now they have ETFs also. We're able to participate very, very easily. Right? So what you should be looking at is how can you participate rather than looking at when should I participate. How should I participate is what you should be looking at as a saver. Right? Whether I have to do it from a bond perspective and I'm willing to I've done my study of understanding what the credit profile of the borrower is, and I'm willing to stay for 12 years, 15 years, whatever the case be, as the tenure also is done. Right. But the expertise that goes into debt is very high because it's not liquid. You can't get out. If there's a bad scenario that happens, you're stuck. Right? You're getting that interest. Sometimes you won't even get that interest, but you're stuck with it. Right. So you should be looking at how you should be participating in debt. But even in this sort of a scenario where interest rates do not go down, do not go up, the opportunity that's there on the debt market is on the shorter side. Right. So when it does come down, we will see where the opportunity is for you to where you need to be on the debt side of the market. Right. There's a comment. I guess most newbies haven't seen the fall of 2008, 2009. This is the reason for such trend on equity chasing. I'll take you to that slide again. No, it's a very good point because we can see where is it that that optimism has suddenly started to come in terms of equity. There's a lot of pumping in of money that has come in into the entire market, right? For everything to go up, you inject the system with liquidity, and the only way you do it is via the debt market, which again goes into the equity market, right? So if you look at since the global financial crisis, if you see here, only the risky parts of the market have gone up. If you look at 2012, 2013, 14, 15, barring 16, which was a bad year, 17, then we had a pause in terms of optimism. We had slowdown in terms of growth, and there were talks of high interest rate that had to sort of ease and give the market a breathing space, and corporates a breathing space so that they can make the most of it when the cycle turns, right? But again, that effect did not come in fully. You saw again riskier parts are only going up. See, there's a bias now that because they have high risk is equal to high returns, but high risk is not equal to high returns. You look at the drawdowns that are coming in 2018 and 2019. So assuming an investor who came in, and that's what I had done in one of the presentations, that let's say you start from 2018 and you're having 2 years of very, very bad drawdown experiences, right? And then the entire space does well. But in 2021, because you started off at a high point, right? In by the time you started off from a plus 60% point of view, your CAGR for the next 3-4 years is barely 3% single digit, and your experience is gone. You've had a bad experience because of this thing, and it's not only one investor. There were a bunch of investors. The entire market had gone through this space of having a bad experience, right? And that defeats the entire purpose of investors actually participating and looking at financial markets as a vehicle to save money, right? It defeats that purpose because we are having this sort of hindsight bias, because we are having this sort of high returns. High risk is equal to high returns, but high risk is equal to high risk. It's not equal to high returns. You are taking risk everywhere. You are taking risk on debt, you are taking risk on equity, you are taking risk even on precious metals. The risks are different. On equity, you're taking more sentiment risk. On debt, you're taking more country specific risk. On precious metals, you're taking more global scenario risk. Right? The risks are different, but the risks are there. So wherever investors have perceived high risk is equal to high return, they've just followed that. Right? So not many people remember it, and they're not aware of it. Is liquidity difficult in debt mutual funds? No. Debt mutual funds do a very good job of making sure that it's very liquid. See, even in the worst scenario, right? If you remember Franklin, they were not able to sell that particular paper because it was credit risk. Right? Credit risk, you have to play only when there's a deep, uh, uh, deep pessimism in the entire industry. Things are looking very, very bad from an investor sentiment point of view. Like for example, during the IL&FS crisis, your creamiest layer, that is your corporate bond funds, were usually, corporate bonds give you somewhere around 5.5-6%. Max you would get somewhere around 7% odd, with the best case scenario for a corporate bond, AAA pure. What happened after IL&FS crisis is that investors got really scared. The entire market got really scared because a AAA, a deemed AAA was going and defaulting. So there was dumping of papers that came in for AAA, and AAA, that is the creamiest layer, started to go. The yield started to shoot up, right? Because there was dumping, and it went somewhere around 9.5%. Right? This was when you had indexation benefit and all that during 28. Right? So at that point in time, for a debt investor, right, and you saw on the equity side, here you go, on the equity side, you are coming off periods of very high small cap returns. You are coming off very high small cap and very high mid cap return. But if you look at your corporate bonds, they are somewhere around, if you look at 16, 17, if you just look at 17 alone, right, it's 7%. But if you look previously to that, you saw, yeah, they're very good. It's quite strong. Right? Then again, when that scenario happened, because there was so much fear in the market, people dumped that. The entire industry was dumping those papers, and we were able to capitalize on them. Right? So they do a very good job of like liquidity, but in times of stress where we've not seen, because it's credit risk, only in these parts of the market where you would see some sort of problem when something deep and something bad happens. Right? That's where the liquidity issue does come in, because you have to hold that paper no matter what. Right? Only then you would see something like a Franklin happen. But kudos to them where they were able to manage the entire scenario and recover the money for each investor. Yes, just delayed. Just there was initial very big fear that came in, but they were able to do it quite well. For a mutual fund, they did quite well. So we just have a couple of more minutes. So I think I can take two more questions, and then we can close. Thank you, sir. Do get in touch with us on this number, and we will be able to guide you very well in terms of your wealth creation journey here in India. There's a question of some apps like Cred Money giving you 12-13% return. See, on the debt side, your focus should be very simple. Is safety, not returns. Equity, yeah, you can prioritize returns, right? Because that asset class works that way. But for debt, you should only look at debt from a safety point of view. Where you have to park money and make some extra money when it more than FD, more than your savings account when it comes to debt. Don't look at debt from a return perspective. Look at debt only from a safety perspective. Equity, yes, you can look at from a return perspective, right? But you have to view each asset class very, very differently. You cannot view debt as equity, nor can you view equity as debt. Right? Nor can you view gold or silver to be like equity. They are very different asset classes. The factors that determine returns is very, very different. Right? So I don't know if they are offering, but what I would say for you is that please look only towards please look at that only from a safety point of view, not from a returns point of view. And if you're planning for your retirement also, then you must have a mix of some asset class, less of the high risk asset classes, but more of two. If you do have some sort of a requirement like that, do get in touch with us. I've put the number there. Just send us a hi, just tell us what your requirement is, and somebody will get in touch with you from our team. Right. Okay, done. I don't think there are more questions. So thank you so much, guys, for joining in on a Saturday morning. Have a great weekend ahead. Thank you so much.